If you bought silver at $87, this message is for you. Not for the person who accumulated quietly at $25. Not for the long-term holder who locked away physical metal years ago and barely checks the daily chart. This is for you, the one who watched the price surge, saw the vertical candle, felt the urgency, and acted. You saw momentum. You saw headlines. You saw acceleration. And you made a decision. I am not here to tell you that you were wrong, but I am here to slow you down before you make your next move. Because what happens immediately after a powerful surge is often more important than the surge itself. Comment below and tell me what price per ounce you bought it last time. Let's see who in our community has stacked the most ounces. Now, let's return to what's quietly shifting beneath the surface. When a market explodes upward in a single session, it creates emotional distortion. The move feels permanent. It feels like confirmation. It feels like validation. But statistically, markets do not move in straight lines. They breathe. They expand, they contract, they overshoot, they retrace, and after a large one-day expansion, the probability of short-term contraction rises dramatically. This is not an opinion. This is observable behavior across volatile commodity cycles. When silver posts a 5% or greater daily gain, the following session historically leans toward digestion. Roughly 2 out of 3 times, the next day closes lower. The average retracement tends to sit near 3 to 4%. That may not sound catastrophic, but if you entered at $87, a 4% pullback places price near $83.50. That is not a collapse. That is not the end of the bull thesis, but it is immediate psychological pressure, and pressure changes behavior. A pullback after you enter at the high does something subtle but dangerous. It shifts your emotional state from optimism to defense. Instead of thinking about opportunity, you begin thinking about protection. Instead of evaluating new information objectively, you look for reassurance. You look for confirmation that your entry was correct. You begin filtering. That is how overexposure happens. The first risk you face is not collapse. It is impatience. When price surges, the final wave of buyers often enters during peak enthusiasm. The early buyers who accumulated before the breakout have room. They can tolerate a pullback. But the late buyer has no cushion. Even a routine retracement feels like threat. Markets test late buyers first. That test often arrives within 24 to 48 hours. The second risk is structural, not emotional. When volatility expands sharply, exchanges respond. They increase margin requirements. This is mechanical. It is formula-driven. It does not care about your conviction or the long-term fundamentals. If volatility crosses certain thresholds, required capital per contract increases. If you are using leverage, that matters. A margin increase can force reduction. It can trigger liquidation. It can create temporary selling pressure that has nothing to do with the fundamental outlook for silver. It is plumbing. It is infrastructure. It is the mechanics of a leveraged market adjusting to volatility. If you are in futures, this matters enormously. If you are in leveraged derivatives, it matters. If you are in cash instruments or physical holdings, it matters less. But price can still be temporarily influenced by those forced adjustments. The third risk is concentration. When momentum is strong, it is tempting to add aggressively. You think, if it is going higher, I should increase my size. But position sizing at emotional highs is historically expensive. The correct time to build large exposure is during compression and doubt, not expansion and euphoria. That does not mean silver is not heading higher over time. It means timing expansion of your exposure during maximum excitement carries asymmetric short-term risk. There is also the simple matter of exhaustion. A market that moves vertically consumes short-term demand. Buyers who intended to enter over the next week often rush in on breakout day. That front-loading reduces the immediate pool of incremental buyers for the following session. Without new urgency, early buyers take partial profits. The result is digestion. Digestion is healthy, but if you bought at the top of the expansion, digestion feels hostile. Now let's talk about psychology in direct terms. Your brain does not experience financial markets in a rational vacuum. When you bought at $87 during acceleration, your nervous system associated the action with reward anticipation. Dopamine reinforces momentum behavior. The stronger the move, the stronger the reinforcement loop. If price continues upward immediately, your behavior is validated. If price stalls or pulls back, cognitive dissonance appears. Cognitive dissonance seeks resolution. It resolves through either reducing exposure or doubling down to prove the original decision correct. Doubling down without objective recalibration is how short-term drawdowns become structural mistakes. So what should you do in the immediate aftermath? You pause. Not because the long-term thesis is invalid, not because silver cannot move to $100 or beyond, but because the short-term risk-reward profile shifts after a 6% expansion. If price retraces 3 to 4%, that is not failure. It is statistical normalization. If margin requirements rise, that is not conspiracy. It is volatility response. If volume contracts after the surge, that is not weakness. It is consolidation. The critical error is interpreting routine post-expansion behavior as betrayal. Now consider portfolio math. If silver represents 10% of your portfolio and you add aggressively at $87, you may push exposure to 20% or more. A routine 8 to 10% pullback then impacts your total capital more significantly than anticipated. Concentration amplifies volatility. Volatility is not inherently bad, but volatility combined with overexposure leads to emotional reaction. Emotional reaction leads to poor execution. If you intend to hold for years, short-term price fluctuation matters less. But if your time horizon is weeks, entry precision matters greatly. Buying into vertical expansion reduces your margin of error. Let's frame the scenario clearly. Scenario 1. Price consolidates between $83 and $86 for several sessions. That is healthy. That builds base, that strengthens structure. Scenario 2. Price spikes further to $92 quickly. Your existing position benefits. You did not need to add aggressively at $87 to participate. Scenario 3. Price retraces sharply to $80 to $82 due to structural liquidation. That is painful, but survivable if your size is controlled and leverage minimal. In each case, patience preserves flexibility. Flexibility is power in volatile markets. The long-term macro structure may be extremely supportive. Structural deficits, industrial demand, monetary stress, supply constraints, all of that may remain intact. But long-term fundamentals do not immunize short-term mechanics. You can be correct on trajectory and still mismanage execution. The first 48 hours after a vertical breakout are not the time to act impulsively. They are the time to observe. Observe how price behaves at retracement levels. Observe how volume responds to pullbacks. Observe whether volatility contracts or expands further. Observe whether consolidation is orderly or chaotic. Information gathered during consolidation is far more valuable than adrenaline-driven entries during expansion. If you bought at $87, your job is not to defend your decision. Your job is to manage risk. Risk management is not pessimism, it is survival. Survival ensures participation when the larger move unfolds. Adding more immediately after a vertical candle often satisfies emotion, but reduces strategic advantage. Waiting 24 to 48 hours costs you little. If price explodes higher without retracement, you still own silver. You are participating. You are not left behind. If price pulls back, you gain optionality. Optionality is everything. Cash reserves are optionality. Patience is optionality. Reduced leverage is optionality. In volatile commodity cycles, the traders who survive are not the ones who predict perfectly. They are the ones who size correctly. You do not need to maximize gains. You need to avoid catastrophic missteps. A 3 to 4% retracement after a 6% surge is common. A volatility-driven margin adjustment is common. A brief 8 to 12% shakeout during strong uptrends is common. What is uncommon is discipline during euphoria. Right now, your advantage is not forecasting the next dollar move. Your advantage is stepping back. Ask yourself, if price drops 5% tomorrow, will I regret adding today? If margin requirements rise overnight, am I prepared? If silver trades sideways for 2 weeks, am I emotionally stable enough to hold without overtrading? These are not dramatic questions, but they are decisive. The market does not reward urgency, it rewards structure, and structure is built through patience. You bought at $87. That may ultimately prove to be a powerful entry, but whether it becomes powerful or painful depends entirely on what you do next. Do not chase momentum simply because it feels validating. Do not expand exposure simply because price is rising. Do not confuse acceleration with inevitability. Give the market room to breathe. Give yourself room to think. The next 48 hours are about observation, not aggression. You already have exposure. Let it work. Preserve capital. Preserve flexibility. And most importantly, preserve the ability to stay in the game long enough to benefit from whatever larger move may be forming. When a market enters an expansion phase like the one that just pushed silver to $87, most participants interpret it as confirmation of strength. And in many cases, it is. But strength and stability are not the same thing. Strength is directional force. Stability is sustainable structure. A vertical price move proves force. It does not prove durability. Durability requires absorption. Absorption occurs when price pulls back and finds support. It occurs when sellers attempt to push price lower and fail. It occurs when volume decreases on declines and expands on advances. Without that process, rallies remain fragile. Fragile rallies can continue, but they remain vulnerable to shock. Shock in commodity markets often comes from liquidity shifts. Liquidity shifts can be triggered by volatility thresholds, risk model adjustments, or simple profit-taking cascades. None of these events invalidate a macro thesis, but they can temporarily distort price. In leveraged markets, distortion is amplified. If volatility expands beyond predefined parameters, capital requirements rise. When capital requirements rise, weaker hands exit. That exit produces supply. That supply pressures price. Lower price increases mark-to-market losses for leveraged participants. That forces more exit. This loop is mechanical. It is not personal. It is not ideological. It is structural. If you are lightly leveraged or unleveraged, you can withstand that loop. If you are fully extended, you cannot. Now consider volatility compression following expansion. Often, after a dramatic surge, volatility contracts sharply. The market enters tight ranges. Breakout traders grow impatient. Momentum players disengage. Volume fades. The market appears boring. This phase is misunderstood. Consolidation is not weakness. It is construction. But if you added aggressively at the high, expecting immediate continuation, sideways action becomes emotionally draining. The opportunity cost feels heavy. That discomfort tempts overtrading. Overtrading erodes capital. Capital erosion reduces staying power. Staying power determines who benefits when the larger trend resumes. There is another subtle dynamic to consider: crowd positioning. When a breakout occurs, positioning often shifts rapidly. Traders who were previously neutral become long. Short sellers cover. Momentum funds engage. This positioning shift can become temporarily crowded. Crowded positioning increases vulnerability to pullbacks because many participants share similar entry levels. If price dips slightly below the breakout level, clustered stop-loss orders trigger. That accelerates decline beyond what fundamentals justify. Again, this is not collapse. It is clearing. Clearing strengthens trends, but only after weak hands exit. If you bought at $87 and intend to hold through volatility, you must ensure your size allows you to be categorized as strong hands. Strong hands are not defined by confidence. They are defined by resilience. Resilience comes from proper sizing, limited leverage, and sufficient liquidity. Now let's examine the concept of average cost. If you accumulated silver at lower prices historically and just added at $87, your blended cost remains favorable. But if $87 represents your initial or primary entry, your tolerance for drawdown is narrower. A 10% correction from $87 brings price to roughly $78. That level is not catastrophic in historical commodity volatility. It is routine. But psychologically, a double-digit drawdown soon after entry feels severe. If your exposure size is too large relative to your portfolio, that feeling becomes destabilizing. Destabilized traders make poor decisions. Poor decisions compound losses. Losses reduce confidence. Reduced confidence prevents rational re-entry, even when conditions improve. This is the cycle you must avoid. Instead of asking, will silver go to $100 next week? Ask, is my position structured to survive volatility if it does not? Survival precedes profit. Profit follows survival. There is a temptation to treat strong breakouts as proof that risk has diminished. In reality, risk often increases after volatility expands. Wider daily ranges mean larger mark-to-market swings. Larger swings require wider stops or deeper patience. If your risk tolerance does not expand with volatility, you will be forced out. Now let's discuss time horizon alignment. If your thesis is multi-year, driven by structural supply deficits, industrial demand expansion, and macroeconomic instability, then short-term fluctuations are noise. In that case, incremental entry precision matters less than overall allocation discipline. But if your thesis is tactical, expecting a rapid move to $100, then entry timing matters significantly. Buying into peak momentum statistically reduces near-term edge. Clarity about your time horizon determines strategy. Confusion about time horizon causes inconsistency. Inconsistency damages performance. It is entirely possible that $87 becomes a distant memory in a much higher price environment months from now. It is equally possible that silver retraces meaningfully before resuming ascent. Both outcomes can coexist within the same long-term trajectory. The difference between those who benefit and those who regret participation is not prediction accuracy. It is behavioral discipline. If you feel an overwhelming urge to add immediately, that urgency itself is data. Urgency often signals emotional participation rather than strategic positioning. Strategic positioning rarely feels urgent. It feels measured. Measured decisions preserve capital. Capital preservation preserves opportunity. Opportunity compounds wealth. In volatile commodity cycles, wealth is not built through single, perfect entries. It is built through sustained participation across phases. Phases include expansion, consolidation, retracement, reaccumulation, and breakout. You entered during expansion. Now, you must navigate consolidation without sabotaging your position. That means resisting the impulse to react to every tick. It means accepting that pullbacks are part of the process. It means understanding that volatility cuts both directions. It means recognizing that adding exposure is a strategic decision, not an emotional reflex. The next 48 hours are not about forecasting. They are about structure. If price stabilizes above key support zones after a minor retracement, that strengthens the trend. If volatility contracts and volume normalizes, that builds durability. If forced liquidation events occur and are absorbed quickly, that signals resilience. Observe these signals. Do not override them with impatience. You bought at $87. That action is complete. Now your focus shifts from entry to management. Management requires calm. Calm requires perspective. Perspective requires distance from emotional noise. Distance comes from patience. And patience is the rarest commodity in a fast-moving market. So, before you buy another ounce, another share, another contract, pause. Let the expansion settle. Let the data update. Let the market reveal its next structure. Your edge right now is not aggression. It is restraint. That is how you protect your capital. That is how you remain positioned for whatever comes next. And that is how you turn a high volatility entry into a long-term advantage rather than a short-term regret. Now, take a breath. Watch the next sessions carefully. Protect your flexibility. And remember, survival in volatile markets is victory. If you can survive the swings, you can benefit from the trend. That is the discipline required at $87. And that discipline will determine everything that follows. You may have entered at $87 during a moment of acceleration, and that may one day look brilliant. But brilliance in markets is rarely about the price you paid. It is about how you manage what happens next. The surge is over. The emotion is fading. Now comes structure, volatility, and decision-making under pressure. If you slow down, protect your capital, respect short-term mechanics, and refuse to let urgency dictate size, you give yourself the only advantage that truly matters: the ability to stay in the market long enough to see the larger thesis unfold.